He did exactly what the government told him to do. He saved extra for his retirement, and for his obedience, he was hit with a devastating penalty he never saw coming. He wasn't audited, he didn't make an illegal withdrawal. The IRS punished him specifically because he tried to use the new 2026 Retirement Super Catch-Up. Welcome to the Final Paycheck. Today, we are unpacking a terrifying new financial landmine hidden deep inside the Secure 2.0 Act. The government marketed it to seniors as a gift, but for a 63-year-old engineer named David, it became a financial nightmare that weaponized his own savings against him. David and his wife Elena were sitting at their kitchen table. David was 63, a diligent saver, making $160,000 a year. He was exactly 2 years away from his dream retirement. He had been reading about the new 2026 tax rules. The headlines were universally positive. The government was finally allowing people ages 60 to 63 to make a massive super catch-up contribution to their 401k, over $11,000 extra a year. David wanted to aggressively lower his taxable income during his highest earning years, so he logged into his HR portal, checked the box, and maxed it out. He felt proud. He was doing the responsible thing. He thought he was securing his future. He had no idea he had just walked into a trap. Fast forward to early 2027, tax season. David sat in his CPA's office, sipping a coffee, expecting his usual sizable tax refund. Instead, his accountant, Mark, slid a piece of paper across the desk. The paper was a tax bill for $4,200. David stared at it. He was stunned.
"Mark, this has to be a mistake,"
David said.
"I maxed out my 401k. I used the new Super Catch-Up. My taxable income should be significantly lower this year."
Mark took a deep breath.
"David, your company didn't put that catch-up money into your pre-tax account. They forced it into a Roth. Every single dollar of that extra $11,000 was added directly back onto your taxable income."
David felt a sudden spike of panic.
"I didn't ask for a Roth. I don't want a Roth right now. I need the tax break."
But what Mark explained next exposed the darkest secret of the new retirement laws. Mark pointed to the fine print of the Secure 2.0 Act.
"David, it wasn't a mistake. It was mandatory."
Because David had earned over $150,000 the previous year, the government legally mandated that his catch-up money be taxed immediately. There was no warning letter, no pop-up on his HR portal, just a silent, automatic payroll switch engineered by the IRS. David sat back in his chair, frustrated. He felt manipulated. But he took a breath and rationalized it.
"Okay,"
David said, rubbing his temples.
"it hurts to write a check for $4,000 today, but at least that money grows tax-free now, right? I guess I can live with it."
Mark didn't smile. He looked down at his desk.
"David,"
Mark said quietly,
"the income tax isn't the real problem here. The real problem is what that extra income just did to your Medicare."
Mark flipped to the second page of the tax return and pointed a pen at a specific box. MAGI, Modified Adjusted Gross Income. When the government forced David's super catch-up into a Roth, it artificially inflated his household income for the entire year.
"David, you and Elena crossed a very specific, invisible tripwire,"
Mark explained.
"It's called IRMAA, the Income-Related Monthly Adjustment Amount."
David was totally confused.
"Mark, I'm 63. Elena's 62. I don't go on Medicare for 2 more years."
Mark nodded slowly.
"Exactly. Medicare has a strict 2-year look-back period. What you earn at age 63 dictates exactly what you pay in premiums the day you turn 65.
Because of the mandatory Roth rule, David's income had spiked over the IRMAA threshold by just $300. Just $300. But that tiny spillover was about to trigger an avalanche. Because they crossed that line, the government was going to add a massive surcharge to both David and Elena's future Medicare Part B and Part D premiums the moment they retired. It wasn't a one-time fee. It was an aggressive, ongoing monthly penalty. By trying to save extra money for retirement, Mark said,
You just accidentally increased your future healthcare costs by thousands of dollars.
David felt the air leave the room. He had played by the rules. He had sacrificed. He had followed the government's advice to catch up on his savings. And for his obedience, he was punished twice. First, with a forced tax bill, and second, with a devastating penalty on his medical care. He realized the terrifying truth. The super catch-up wasn't just a benefit. For high earners, it was a perfectly disguised wealth transfer mechanism. But the nightmare for David and the desperate scramble to undo the damage was only just beginning. The drive home from the CPA's office felt like a funeral march. David gripped the steering wheel. He was supposed to be the protector, the one who managed the spreadsheets, the one who made sure his wife, Elena, would never have to worry about money when they got old. He walked into the kitchen. Elena was at the counter chopping vegetables for dinner. She took one look at his face and put the knife down.
David, what's wrong? Is it your health?
No, David swallowed hard.
It's our retirement.
He explained the Roth trap. He explained the tax bill. And then he explained the IRMAA Medicare penalty. Elena looked confused.
But you're the one who made the extra contribution, David. Why are my Medicare premiums going up?
David felt a sickening knot in his stomach.
Because we filed jointly,
He whispered.
the penalty doesn't just hit me, it hits you too.
Because of David's attempt to save a little extra, the government was legally allowed to reach into Elena's future pocket every single month for the rest of that year. The next morning, David was in a cold sweat. He called Mark, his CPA, at 7:30 a.m.
Mark, we just undo it, right? We recharacterize the contribution. I'll pull the $11,000 out. I'll pay a penalty, whatever. Just lower my MAGI back under the threshold.
On the other end of the phone, Mark let out a heavy, exhausted sigh. The kind of sigh that only a tax accountant makes when they know the law is rigged.
David, you can't.
What do you mean I can't? It's my money.
Under the old laws, maybe,
Mark explained.
but the Secure 2.0 Act closed that door. When an employer makes a mandatory Roth catch-up based on your previous year's wages, it is locked in. Once the tax year flips, the IRS does not allow you to recharacterize it.
David was completely trapped. There was no form to file, no appeal to make. The government had built a financial mousetrap. They put the cheese perfectly in plain sight, and once it snapped shut, it was permanently welded closed. Later that week, David went to his office. He felt like a ghost walking the halls. He ran into Richard, a 66-year-old senior engineer who had semi-retired the year before, but still consulted. Richard noticed David looking sick. David pulled Richard into a conference room and quietly confessed what had happened. Richard didn't look shocked. He looked completely defeated. "David," Richard said, staring out the window.
They got me 2 years ago.
Richard pulled up his bank app on his phone and pushed it across the table.
I thought I was being smart, just like you.
Richard whispered.
Look at my Social Security deposit.
David squinted at the screen. The monthly deposit was shockingly low.
They don't send you a bill for the Medicare penalty in the mail, David.
Richard said bitterly.
They deduct it instantly from your Social Security check before you ever see it. I worked my whole life for that benefit. And the IRS cannibalized it because I tried to save 10 grand in my 401k.
David realized he wasn't just looking at a phone screen. He was looking at his exact future. David couldn't save himself, but he forced Mark, his CPA, to help him build a survival plan for his younger brother, who was turning 60 next year. This is the exact forensic strategy you must use if you are approaching retirement. First, the years you turn 62 and 63 are the most dangerous tax years of your life. Every single dollar you earn is heavily audited for future Medicare penalties. Second, if you earn over $145,000, you must aggressively calculate your MAGI before December 31st. If you are within $2,000 of an IRMAA bracket threshold, you do not use the super catch-up. You stop. Instead, you divert that money into a health savings account, or you push your year-end bonuses into a deferred compensation plan. You must act like a defense attorney protecting your own paycheck, because the government is not your financial advisor. They are a collection agency, and they will use your own good intentions against you. 2 years later, David and Elena finally retired. They had their cake, they had their party, they moved to a beautiful lake house in Michigan. But a few months later, the mail arrived. David opened the envelope from the Social Security Administration. It was their first official benefits breakdown. There it was, printed in stark black and white ink. The IRMAA surcharges. A brutal monthly deduction scraped right off the top of their lifetime benefits, all because of a $300 mistake at age 63. David sat on his porch, looking out at the water. The money wasn't going to bankrupt them. They would survive. But it was the betrayal that haunted him. The sickening realization that the financial finish line he had sprinted toward was actually a tripwire. If you are in your late 50s or early 60s, do not check a single box on your HR portal until you know exactly where that money is going. Check your pay stubs, talk to a fiduciary, and please share this exact video with anyone you know who is turning 60. I'm your host. Protect your final paycheck. We'll see you next time.